during periods where this like inflation levels are pretty low, uh, like say this past decade, basically there's not a lot of commodity scarcity. Things are more kind of focused on financialization. Businesses get rewarded for being asset light. Basically, if they can rent things instead of own things, take everything off their balance sheet, put it elsewhere, they benefit from that. But during inflationary periods, when you start running into supply chain issues, that's where owning your own assets becomes more useful. That's where being vertically integrated is more of a feature, and the replacement costs for those assets start going up dramatically. And suddenly, all these businesses that were trying to emphasize having high returns on invested capital, trying to be asset light as possible, that are then very expensive because people have recency bias. Those things got bid up to such high levels. When you have a regime shift towards more scarcity, towards you change the money supply, so you change demand, and then you run into demand constraints supply constraints you didn't know you had before. All those assets become far more valuable to people because they are harder to build than people thought. They're harder to replace than people thought. And that's how sometimes you get these big growth to value stock cycles. And that's where some of the expectations on inflation can be misplaced because they don't take into account the fact that, say, for 10 years, you can be kind of coasting on depreciating assets. You can, things that you built 10, 20, 30, 40 years ago are still serving a useful purpose. And you're saying, look how low inflation is, but it's because you're not having to rebuild and replace them. But over a long enough timeline, when you actually have to start building them and replacing them, it becomes more inflationary. And you realize that all your monetary policy and all of your policies are kind of geared towards that more disinflationary environment that you thought was permanent. And so that's I think one of the challenges the policymakers are going to run into and that businesses are going to run into probably throughout this decade.
Yeah, I agree entirely. All right, well, unlike the vast majority of people who talk about markets, you have the remarkable distinction and courage to put up your portfolio on your website for everybody to see, which I think is admirable because you're putting your track record out there for people to look at. Tell us, what do you have in your portfolio, and why do you hold so little Bitcoin and Bitcoin-related companies in your portfolio?
So in that newsletter, that's like a newsletter portfolio. So that's not all my assets. That's like a specific portfolio that I track for that newsletter. The challenge with that platform is that they don't have Bitcoin as a holding, and they don't even have GBTC because it trades over the counter.
Okay.
And so the only way to get exposure is with stocks like MicroStrategy or the miners. And so that general portfolio, what I try to do is I do a spin on like the 60/40 portfolio where I say, okay, let's have a diversified asset base, but let's try to find better things than bonds to hold, with most of that. And so what I do is I have a section for, say, dividend stocks. I have a section for international stocks. I replace some of the bonds with other types of assets. And I do have a segment for digital asset related companies, mostly Bitcoin focused companies, MicroStrategy and the miners. But for example, in my research service, I have other portfolios that people can look into where I do use things like GBTC because that's available on other platforms, obviously, just not that particular platform. And then also I recommend Bitcoin cold storage, right? So I shared my readers back in, it was April 12th, I think, that I recommended, April 12th, 2020, that I recommended Bitcoin. And then I went and bought it on April 20th. So I buy most of mine, originally I bought through an exchange, but then I shifted over to Swan Bitcoin because they were Bitcoin only and I liked their product offering. And so I kind of separate how I manage that particular portfolio from just total assets in general, kind of like how I wouldn't have my house listed in that portfolio, if, real estate holdings, things like that. I consider Bitcoin best held as directly held property. And the best percentage, I think, varies depending on who it is, right? So I think for most people, the answer is, it shouldn't be zero Bitcoin, and exactly how high of a percentage of Bitcoin they want to go partially depends on when they bought it and how much it appreciated. And as well as things like what is their level of knowledge, what is their volatility tolerance, what are their financial goals. And so, that's one of my portfolios among several that I track for my clients.
Oh, I see. Okay. All right. So, other than Bitcoin, if somebody wanted to dabble in markets over the next couple of years, I mean, I think in general, as a little disclaimer, I think the appeal of Bitcoin for me is that if we had a world with Bitcoin similar to what we had with the gold standard, investment would be something that people would only do when they find a particularly useful, good opportunity. It would not be a second job. Most people would focus on their own job, and then they'll take their earnings and they'll put them in the gold coin or in the Bitcoin, and they earn that money and they put it there, and it stays earned there. It's saved. They don't have to go speculating on commodities and trying to understand Japanese monetary policy and trying to figure out what the euro is going to do and what's going to happen between Greece and Germany in order for them to keep their savings. So I think one of the appeals of Bitcoin is that it would bring us back to that world. And I think I see this already with a lot of Bitcoiners, where once you no longer have to worry because you are in Bitcoin for the long term and you trust that Bitcoin is going to do well in the long term, which it continues to do, even with all of these crashes, it's still up many multiples over the last couple of years. When you look at it this way, you have the freedom not to trade. So I'm not recommending that people go out there and trade fiat markets. Only put in fiat what you can afford to lose. But if somebody wanted to go and be reckless with fiat markets, where did you see a safe haven or an opportunity over the coming years, given all of these inflationary, stagnationary headwinds coming at us?
So generally, I find that the natural resource space still has reasonably attractive opportunities, as well as generally some of the higher quality international value type segments. So not the melting ice cubes, but the ones that actually have basically future-proof businesses that haven't really benefited from this huge increase in earnings multiples. Because as you pointed out, people monetize investments as money for lack of good money. And so, in this environment where, their bank accounts yielding zero, official CPI is running at 7%, even before this inflationary period, I mean, even over the past decade that was disinflationary, if you look at real T-bill rates or real bank cash rates, they were below zero for the vast majority of the past decade. It was mildly below zero, but it was below zero. And so because that money situation's been so weak, there's been a natural tendency to just stuff as much capital as you can into equity markets in particular. Also second homes and trophy assets and things like that. But for a lot of people, it's equity markets. And even for a lot of foreign investors, it's U.S. growth equity markets. And so if you look at valuations over time, so much capital has been shoved into them that now you can have much lower forward expected returns, even from good companies, just because their multiples are so high. And so one of the things I find is looking for equities that have not already been monetized, right? So that don't seem to have a monetary premium on top of their cash flow generation potential. And so there are certain value-oriented sectors in the United States. I think, for example, energy infrastructure. We went back before about the replacement cost, right? In an inflationary environment, having a very asset-heavy business can be useful because you have assets that are much harder to produce now than they were when those were built. And so I, for example, like some of the energy infrastructure in the United States and Canada. And when I look internationally, there are kind of, healthcare stocks. There are kind of, I think, more value-oriented type of plays, some commodity resources that I like. But I agree with you. In a perfect world, most people shouldn't have to focus on investments in order to, make money in a relatively stable way. Right now, the challenge is that cash itself loses value, generally slowly, sometimes quickly, depending on where you live. And then you have harder monies you can choose. So gold's one of them, but it has now a new risk to Bitcoin, and there's Bitcoin. But because it's so volatile, a lot of people can't afford to put all their money in it, or even half their money in it. They put a certain percentage into it. It's different for someone who put, say, 1,000 hours of research into it, super high conviction, bought it, 5 years ago. They can hold a higher allocation, whereas for a lot of people, some percentage I think is appropriate for them. And so the challenge is trying to navigate this environment and saying, okay, we're watching Bitcoin monetize in real time. but maybe you don't want to be 100% in Bitcoin. And so I go around and kind of find all these different assets that I think are likely to hold their value through, say, currency weakness, through currency transitions, through inflationary environments, and that also can survive periods of disinflation. So when the Fed tries to tighten policy and tries to kind of slow some of that down, you know, going back to the earlier point of like the most indebted are the ones that win, that's true as long as you're, it's almost like you want to be second place. You want to be as indebted as you can, but you don't want to be the most indebted because the most indebted are the ones that, fall first, right? So in a liquidity crisis, you don't want to be the one that's over your skis. You want to be the one that's, leaning in, but still able to navigate and kind of round the turn and get down to the bottom of the ski slope. And so I look for businesses that are benefiting from inflation, but that are also, say, conservatively leveraged, that they're not the most leveraged ones in the industry that might blow up along the way. And so that's how I generally try to find assets in this environment.